Hello, my name is James Cordiner. I'm one of the senior tax consultants working in the tax investigations team at Markel Tax. And in this short webinar, I'm going to cover some topical tax matters which I trust will be helpful in your day-to-day work. There are three areas I want to focus on in this webinar. Firstly, we'll look at current HMRC activity in relation to inquiry work and the tactics deployed by HMRC. We'll then have a look at some of the areas where we've seen increased activity by HMRC and give some comments on current issues. Finally, I'll summarise the disclosure facilities that are still available for making a disclosure to HMRC with some thoughts on the key areas to consider when making such a disclosure. So we'll start off with HMRC activity. In my first slide on HMRC activity, you'll see a number of areas that have been a basis for HMRC inquiries in recent years. The reality is that the vast majority of tax inquiries instigated by HMRC are information-based, with HMRC utilising information from a wide range of sources, some of which are made available to HMRC from third parties, such as government departments, financial institutions, and also information that is in the public domain. This includes social media, which has been used more and more as a useful information gathering tool in recent years. With regard to property-based inquiries, we've seen many inquiries where HMRC are aware of additional properties owned by individuals, and this comes from the land registry data as well as other public domain sources. Where it appears that no rental income has been declared, this is an obvious source of concern to HMRC, as it begs the question that if a second property is owned, what exactly is it being used for? Added to that, HMRC will be keen to establish how the purchase was funded, particularly if this appears inconsistent with the income declared on the tax return. HMRC also use credit reporting companies such as Experian to identify individuals' financial commitments, and again, if this appears out of sync with the declared income, this will raise concerns for HMRC, and it is not unreasonable for them to seek to address those concerns. It's therefore vital that the facts are established in each case to consider whether there have been any omissions that need to be addressed. With regard to the use of merchant acquirer data, HMRC have data gathering powers to obtain card transaction data, and this has been utilised to check the income return in certain types of businesses, including restaurants and retailers. This has been used to risk assess businesses that should be VAT registered and has been a useful source of information for HMRC's hidden economy teams. This information is valuable in identifying businesses that appear to be deliberately keeping themselves below the VAT threshold. With regard to other sources of information, HMRC also receive information from other institutions such as financial institutions, banks and pension providers in relation to interest received and also withdrawals from pension funds that may be taxable. Again, where corresponding entries do not appear on the tax return, HMRC will investigate this to establish whether there has been an omission of income. In summary, whilst HMRC have access to more information than they did in the past, and inquiries are much more focused, it doesn't automatically mean that every HMRC inquiry relates to a tax take or leads to a tax take for HMRC. Some information held by HMRC does come with a health warning and can and should be challenged if it's considered that the information they have acted upon is not accurate. The inquiry process is based upon risk, but those perceived risks may be easily addressed. HMRC do make some assumptions, and ultimately it is the facts of each case that are important. It may well be the case that some explanations are needed to address their concerns, but the truth will set you free. On the next slide, I've listed some areas in relation to HMRC's approach to investigations that are ongoing. For example, HMRC have adopted various tactics in recent years, such as the use of so-called nudge letters. These tend to be issued in a scattergun approach to a particular sector or group of individuals in the hope that it will encourage some of those to come forward and make a disclosure of any tax irregularities. We've seen this most recently in relation to offshore matters, where HMRC have written out saying they have information to suggest that a disclosure may be required and that the individual should consider their tax position. This approach has been a regular theme over many years during HMRC campaigns, with the policy of encouragement to disclose any irregularities sooner rather than later, to avoid a harder line being taken by HMRC, particularly in relation to penalties. It's fair to say that this approach has probably been quite cost effective for HMRC during an ongoing period of transition for the department. We regularly see HMRC issuing letters which they refer to as discovery inquiries, although this terminology is somewhat misleading. HMRC certainly have the power to assess using discovery legislation, but not to open an inquiry. However, these letters do need to be given serious consideration, with the key questions that arise being what is it HMRC have actually discovered and what was made available to HMRC within the original return. The matter of discovery can be a somewhat debatable one, and whilst the discovery legislation sometimes feels heavily weighted in HMRC's favour, there have been some notable wins at tribunal recently where discovery assessments made by HMRC were found to be invalid. Again, the facts are crucial in each case in determining whether HMRC have indeed made a discovery. Finally, in this section, we have seen HMRC requesting private financial records as a matter of routine in some inquiry cases on the basis that these are reasonably required. This goes against the tradition of reviewing the business records in an inquiry to check the robustness of these before making such requests, and could be argued goes against HMRC's own guidance on the subject on the timing of such requests. It does, however, appear to have become policy in some sectors within HMRC, specifically the Wealthy Mid-Sized Business Compliance Unit, and we would suggest challenging these requests at the outset of an inquiry, as well as asking the case officer for details of the perceived risks to get some meat on the bones as to the justification behind it. HMRC do seem to take the view at times that they cannot be satisfied that everything is in order without sight of the private bank statements, irrespective of the quality of the business records maintained. It may be during any inquiry as matters progress that the private financial records do need to be provided, but whether this request should be included in the opening letter is certainly subject for debate. HMRC will use their formal powers under Schedule 36 as they see fit, and it is important to consider what information and documents are being requested and whether these are reasonably required for the purpose of checking the tax return under inquiry. We're now going to move on to the next section in the webinar and have a look at some areas where we've seen an increase in activity by HMRC. I've referred to these as current hot topics, and the first of these is loss-making businesses. It stands to reason that HMRC will be interested in the commerciality and viability of a loss-making business, especially where losses have been offset against other income. We've seen a particular increase into farming cases where losses have been claimed and set against other income beyond the 5-year limit. This would not be expected by HMRC, and in a particular recent case that I've been involved with, sideways losses had actually been claimed for more than 20 years, which was cause for concern, although why they hadn't picked it up sooner was a little bit questionable. Thankfully, they took a sensible and reasonable view in the case in terms of the adjustments sought and the penalty position. With regard to online traders, in an era of pretty much everything being available online, HMRC are always keen to ensure that online sales have been accurately recorded. They will request copies of PayPal accounts and details of the online activity for businesses that trade in this way. This has also been a useful tool to identify traders who have not registered their business for both tax and VAT purposes, and again is a target for the hidden economy teams. With regard to some other areas, we've seen evidence through our claims team and the calls to our helplines of an increase in HMRC challenging certain types of claims, including entrepreneurs relief, foreign tax credit relief, capital allowances and AIA claims, as well as the high income benefit charge where a tax charge applies and has not been declared properly in the tax return. HMRC have also taken an interest in niche businesses. To some extent, this is to gain a better understanding of certain businesses that do not fit with the norm. At the same time, we're still seeing plenty of traditional type inquiries into restaurants, service trades, hairdressers, and other businesses such as hotels and accommodation providers. There are 3 other areas I would like to touch on where we've seen an increase in HMRC activity. Firstly, security bonds. HMRC appear to be more proactive in this area in requesting bonds in cases where they believe there is a risk that the tax or duty will not be paid. A legal document, known as a notice of requirement, is issued in these cases, and the business owner has 30 days to disagree, stating their reasons why. It may be that the quantum or calculation of the bond amount can be challenged, and this can be taken forward to an independent review, possibly alternative dispute resolution, or a tribunal. There would, however, have to be a credible argument against the bond amount to go down these avenues. It is important to note that it's a criminal offence to not give the security requested, and these notices are extremely serious for a business, as they cannot legally make taxable supplies if they've not given the security in full. HMRC tend to target businesses with a history of non-compliance with these notices. If there is an argument to make against the bond amount, this should be considered with the appropriate representations being made to HMRC. I want to touch on the loan charge. This has been hugely topical in the last few months, with lots of comment and activity on social media and in the press on this particular area. I've given an overview of this issue on my slide, as you'll see, and the key point to make at the moment is that there's currently an independent review of the loan charge being undertaken, so matters are essentially on hold. If matters have already been settled with HMRC, there will be no effect. However, for anyone yet to settle, it is sensible to await the outcome of the review. HMRC have written to individuals advising that they will not be adversely affected by putting any settlement on hold meantime, which is of course good to see. I also want to mention IR35 issues, and in particular we've seen recently HMRC's aggressive stance and tactics following the issue of 1,500 letters to GlaxoSmithKline contractors. The key advice for any contractors contacted by HMRC questioning their status is to have their contracts reviewed independently together with their working practices. It is important that both aspects are considered to ensure that the contract actually reflects how the work is undertaken. Given the changes to the decision-making process in the private sector coming in from April next year, it is important that individuals potentially affected by the changes are in a position to protect their status where this is possible. This is obviously based on the fact of their engagement and the work undertaken. This does continue to be an area targeted by HMRC, and it is essential that due diligence is undertaken when considering the status position. In the final section of this webinar, let's consider the current position on HMRC disclosure facilities. The disclosure facilities that are still available to be used are firstly, the Let Property campaign. The fact that this facility remains open tells us how successful this has been for HMRC over the years. The facility commenced back in August 2013 and was originally intended to last for 18 months. The facility can be used for landlords with residential property to disclose any tax underpaid, and as things stand, there is no end date for this campaign. When dealing with offshore matters, we're looking at the Worldwide Disclosure Facility. The requirement to correct deadline of 30th September last year has long since gone. However, the facility remains open, again, to disclose any issues that relate to offshore matters. Any disclosure, however, made at this stage may result in higher penalties under the failure to correct penalty regime, which are quite severe and too detailed to cover in this short video. I want to touch on the Contractual Disclosure Facility as well, which gives an opportunity to tell HMRC about a tax fraud, and the offer is normally made through a Code of Practice 9 inquiry. However, you can approach HMRC to request using CDF in a voluntary disclosure of tax fraud where this is considered appropriate. The main benefit of this facility is protecting the client from potential prosecution. And finally, there is the option to make a voluntary disclosure to HMRC through the online facility to correct a tax issue. HMRC have encouraged the use of online disclosure facilities in recent years, with a full disclosure, calculation of the tax underpaid, interest, and the proposed penalties submitted for HMRC's consideration through such a disclosure. If they're not happy with any element of the disclosure, this may lead to further queries on the completeness and accuracy of the disclosure. In my final main slide, I've listed the key points to consider when making a disclosure to HMRC. It is vital that a full and complete disclosure is made for all relevant years, and there are a number of factors to take into account. Detailed discussions should always be held with clients to establish the facts and to determine the extent of the disclosure. So, my advice when dealing with a disclosure is the following. Firstly, consider the full extent of what needs to be disclosed. You need to establish the emission or emissions. For example, in a let property campaign scenario, when did the rental income actually commence? What advice was sought at the time, if any, and why was the income not disclosed? You then want to consider whether returns have actually been filed. This is important from determining if a failure to notify situation exists for any year, and the penalties are different for failure to notify cases when compared to dealing with an inaccuracy in a tax return. Has there been a failure to notify in any year? We've just touched on that in the previous comment, but it is important to consider why the failure arose and the effect on the relevant years and penalties. The disclosure can be restricted if there was a reasonable excuse, and there was no unreasonable delay in dealing with the matter when the reasonable excuse period came to an end. The question of whether a reasonable excuse exists is somewhat subjective, but it is worth exploring if there were specific circumstances that led to the client's failure to comply with their tax obligations at the right time. With regard to the relevant years, in a failure to notify case, essentially you're looking at a 4-year window if a reasonable excuse exists, but if not, the time limit can be extended to 20 years, which is clearly a serious situation for the client. The behaviour categories in failure to notify cases are non-deliberate and deliberate. When dealing with an inaccuracy in a return, you then have to consider the client's behaviour. Has reasonable care been taken? Was it a careless scenario or possibly even deliberate? Given that the time limit for a careless inaccuracy is restricted to 6 years, it is vitally important to determine the correct behaviour, as any deliberate penalty opens the doors to HMRC potentially assessing 20 years. With regard to penalties, when considering the penalty situation, again, if an argument for a careless rather than deliberate penalty can be made, not only are you restricting the years that HMRC can assess, but you're also reducing the penalties significantly from a minimum of 35% for a prompted disclosure to 15% in the same circumstances. Added to that, and more importantly, if you can successfully argue that the behaviour category should be careless, then you have the opportunity to have the penalty suspended, if appropriate. It's important to think about the timescale for making a disclosure too. Given that there are specific time limits for making a disclosure, if we use the example of a worldwide disclosure facility case, you have 90 days from the date HMRC notified their acknowledgement, and it's important to consider the level of work required to complete this disclosure on time. Of course, it's important to register the disclosure as soon as possible, but consideration needs to be given to the time needed for making the disclosure in full and also the client's ability to pay within that 90-day period. It's vitally important to test the client on the information they give you to get a clear picture of what has happened, why it happened, and what could have been done differently to avoid the errors. These are the areas HMRC will want clarity on, and these should be established as part of the disclosure process as early as possible. The final point I would make is that ultimately HMRC need to be satisfied that the disclosure is complete and correct in all aspects. If they're not, queries may arise, which will of course need to be addressed completely before the disclosure can be accepted. So, in conclusion, thank you for taking the time to watch this webinar. I hope that the areas covered are useful to you in your day-to-day work, and if you have any queries on these matters or any other tax issues, we'd be happy to assist. My details are included in the final slide just for information. Thanks once again for watching.